Yeah, I mentioned annuities is also another opportunity. I've spoken about annuities for a long time. Interestingly, a few articles recently in the Wall Street Journal, other trade magazines, have indicated that people still rate their advisors their number one source of advice, just ahead, barely ahead of the internet, which I guess makes me happy that people are still coming to good advisors for advice. And I hope we still stay in a position that we can help the clients. And one of the ways that one of the things that has been a trend amongst advisors is that the typical advisor nowadays is trending away from the traditional investment allocations. The old general rule of thumb that if you're 60 years old, you ought to have 60% in bonds and 40% in stocks, and that's kind of the general rule. And as you get older, you reallocate to match something close to your age, as considering bonds as being safe money. Well, we know that asset allocation doesn't work like it used to. It seems like all investments seem to be kind of in lockstep one with another. If the markets are bad, everything's bad. It used to be that diversification had some offsetting characteristics to that would make it to where you didn't really lose your shorts in bad markets. When everything crashed in 2007 and 8, or mostly 2008, there wasn't much of many people at all in a traditional investment portfolio that didn't feel the hit and feel some stress. And many of those people have not made it back to even yet, even though the markets seem to have recovered a bit. The bond market's done well, mostly because of interest rates falling and the appreciation on the bond market itself. Aside from the traditional market, and why people are trending away from it is because people are more and more concerned about their longevity. Their perception of their life expectancy is growing with time. Everybody thinks they're going to live longer, and guess what? They're right. People are living. For example, right now, people's life expectancy is 10 years longer than it was expected to be 30 years ago. I mean, that's a big change. So with people living longer, people worried about how the markets are performing, there's generally a focus on how to protect long-term income. That drives us to a discussion about when to take Social Security benefits, for example. Are they even going to be there? What about my pension? Are those pension funds really secure? Is there going to be enough future economic growth for that company or that entity that offers me my pension to be there? And so more and more people are looking towards annuities. Interesting fact that this year, the annuities traditionally, by the way, have been the most unsolicited product on the planet. In other words, it's the most unsolicited from the client base. A client doesn't call their broker and say, hey, can you tell me about annuities? I'm considering an annuity. However, the requests for annuity this year, soliciting annuities, went up 15%, which is an incredible growth rate. People now are asking their brokers about annuities rather than waiting for their advisor, their agent, or their broker to say, hey, have you considered an annuity for your income planning? So it's a trend that I think is good, that the marketplace is finally seeing that there's a benefit and there's a place for these annuities. Interesting, annuities sales as a whole, even though the solicitations for annuities were up last year, overall annuity sales were down 10%. I think it was last quarter or the quarter before that. Interesting trend. Why would they be down? Well, it's mostly because the variable annuity market has been pulling out of the market. I've talked about this before on other interviews, that variable annuities are attached to the stock market. They go up and down with the market, and if they're offering some sort of a future guarantee of payout over your life, they might have trouble in a volatile market making those guarantees work for you. In fact, Hartford is one of the companies I've mentioned in the past also that's actually offering cash for annuities. They're actually buying annuities back from customers at a higher than market rate just to get out of the future obligation of paying those long-term income rider benefits. Does that mean all income riders are bad? No. Here's an interesting statistic. The sales of fixed index annuities, that same quarter overall annuity sales were down 15%. Fixed index annuities were up 10%. They increased. Why? That's because fixed index annuities don't risk your money. They put your money in a safe place. They don't make a whole lot of interest, just like you can't make a whole lot of interest. But based on their economies of scale and the volume of business they do, they make enough interest to pay a nice healthy rate of return to guarantee that principal and have a much higher level of confidence, security, and guarantee that they can pay you that income rider for life. And that's why we're still seeing some of the fixed index companies out there paying 6.5% on the growth cycle of your income annuity, paying 5, 6, or 7% on the payout portion of your annuity when you get to a particular age, which are unheard of and have been unheard of for years in the variable side of the annuity market, but are still out there. I will say this, all tax-deferred vehicles, including annuities, life insurance, 401ks, and all the tax-deferred vehicles I've mentioned are on the radar scope of Congress. Lawmakers are looking at ways to tax them to get rid of the benefits that are offered by those vehicles so that they can raise more revenues. And we know the government's not very good or notorious for spending less. They're usually finding ways to raise more revenues. And so if you're not involved heavily into your life insurance planning, your annuity planning, in all those tax-deferred vehicles that you can take advantage of, even Roth IRAs, for example, is another one I haven't mentioned, but all those products that are on the lawmakers' radar right now, you ought to consider whether you've got what you need. And if you don't get what you need, if you do, then feel comfortable that you're in a good position, because those benefits of those vehicles may not be available to consumers in the near future.